Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me as always is Vivek Iyer. Well, it continues to be a down day. It's a 250-point cut on the Nifty. The mid-caps are slightly outperforming. It's a market like this where we are calling a 0.5% a relative outperformance. But other than that, Bank Nifty continues to put pressure on the Nifty, and a lot can be attributed to what we've been seeing in the global markets as well.
Right, absolutely right. Like we mentioned yesterday, 9 days. Yesterday was the 10th straight session where you actually saw the Dow fall significantly. And on the back of that, we are taking those weak cues and also going ahead and seeing quite a bit of a sell-off. The Bank Nifty, like you mentioned, the top laggard. But we have quite a lot lined up in this specific show. Let's start off with the top headlines. The Dow slides over 1,100 points, or over 3.5% following hawkish indications from the US Fed. Indian equities slip in sympathy but seem more resilient ahead of F&O expiry today. Metals, financials and IT are the big drags. Pharma surges. Mid-caps relatively outperform.
DOM slips over 5% after 4.6% equity worth 808 crore rupees. Change hands at 2899 rupees a piece. Sources say Fila is the likely seller.
Yatharth Hospital surges as sources suggest that the company could raise up to 700 crore rupees via the QIP route. Proceeds to be used for debt repayment and funding part acquisition costs of 2 hospitals in Delhi and Haryana.
CNBC-TV18 News Break is confirmed as Zaggle launches a QIP with an issue size of up to 750 crore rupees. Sources say the indicative price is set at 523.2 rupees a share. Stock is down over 3.5%.
AU Small Finance Bank under pressure post a note from Citi. Brokerage firm issues a neutral call with a target of 684 rupees a share. Says continued muted economic activities pose downside risk to asset quality.
Okay, all right. That's the market headline that we are tracking today. A lot of specific stocks which are on our radar. For now, the Nifty is down 1%. There's not been any recovery so far. We've been consolidating below the 24,000 mark, and that's been the trend since the morning as well. It's the pharma index which is bucking the trend today. That is the sole gainer as we speak. The PSU banking index did see some recovery, but then again, largely financials are the reason why there's a lot of pressure that we are seeing. It turned into the green, but then again, there was a fall on the PSU banking index. The financials continue to be under pressure. A lot of stocks at a 52-week low level today, some major ones as well. So we'll track all of that. Of course, Hormaz will be joining us in just a bit. But there is no sign of recovery as such. You know, people thought December could see some cheer, but that hasn't come so far.
No Santa rally ahead here. We are clutching at straws here, talking about the fact that there's been an intraday recovery. But the fact is that, you know, all of the benchmark indices and the headline indices continue to see significant cuts. Like you mentioned, it's the pharma pack that's doing quite well. Dr. Reddy's on the back of the upgrade of Nomura. You know, it's the one that's the best performing as far as the pharma pack is concerned, and other pharma stocks too doing quite well. But this is a special segment, Mid-Cap Movers. Hormaz is standing by the wall to take us to the mid-caps that are moving around in the session.
Well, nothing can summarize what you just mentioned, that a 0.5% fall is considered outperformance. It shows you the kind of market that we are in right now. But the broader markets has a lot of losers today. DOMS is one of them after the block deal. The lock-in period also ending. At one point was down 7%, so there's a slight recovery from the lows. Craftsman Automation was up 14% yesterday. A sudden spike that was seeing some bit of profit booking right now. Triveni Turbine and Jubilant Ingravia too feature among those losers that are seeing losses between 3 to 5%. As you mentioned, Pharma is the only sectoral index that is holding out, be it large cap pharma, mid cap pharma, all of them doing well. Ipca Laboratories now at the highest point of the day. Promoters selling shares. The stock is up 5.5%. The Torrent Pharma, Abbott and JB Chemicals too seeing healthy gains in today's trading session. Some of the other stocks that are in focus in today's trading session, and Sonata Software. Midcap IT is slightly mixed. Most of the IT stocks are still lower, but the recovery that we have seen after the gap down in Persistent Systems and Coforge is a bit of a highlight, and 2% up now are both of these names, and the best performers on the IT index too, mind you. Some of the stocks that are doing well on the back of volumes, and KFin Technologies is moving higher after a brokerage report yesterday. Chennai Petro, Keynes Tech as well at the highest point of the day, 7.5% higher on very strong volumes. And lastly, some stocks that are bucking the trend in today's trading session. Some of the others, of course, apart from these ones. Sirma SGS up at the highest point, as is IFCI, Anantraj and MGL, gains of anywhere between 2 to 6%.
Oh yes, the oil and gas space seems to be coming back, making a comeback, be it OMCs, be it the city gas distribution companies. Thank you so much, Hormus, for joining us as always and telling us some of these stocks which are on our radar. Moving on now, Parle Products in Britannia has announced price increase across the board. Shilpa is here with more details. So biscuits going to be costlier now, Shilpa?
Well, you know, it's not just biscuits, it's biscuits, rusks, snacking products, cakes, everything that these companies sell. So I'll start off with Parle, which is the latest information that we've gathered is that, you know, Parle Products is set to roll out price hikes, which will be 5% and above. And these price hikes will be across the board, across its product portfolio, which will be across bread, biscuits, rusk, its cake items, its snacking items. And these will be rolled out in January. And the price hikes, like I said, will be a minimum of 5% and upwards. There also is going to be a grammage cut where the entry and the low unit level price packs, you know, like your Parle G 5 rupee, Parle G 10 rupee and other smaller biscuit, Monaco, Crackjack, all these entry-level packs will also see a grammage cut of anywhere between 5 to 10% depending on the pack size. Now, like we know, this is on the back of rising raw material prices. We've seen prices of wheat flour, of sugar, of cocoa rise, and, you know, more importantly, the import duty on palm oil prices also pushed up inflation for palm oil. Those prices are up nearly 45% is what is the commentary that we've been hearing from companies. And this comes close on the heel of Britannia also saying in the last quarter that they have hiked prices across several product portfolios, and in the next 2 quarters also they are likely to hike their prices by 4 to 5% in the next 2 quarters, and this will be in certain SKUs that they already did not hike prices on. This is to reduce sort of, you know, the inflationary pressure that could come on consumers because of rising prices. But yes, it's not going to be just these. We are going to see price hikes actually across the FMCG portfolio going forward on the back of rising raw material prices. Back to you.
Thank you so much for that, Shilpa. Very important development over there that you've highlighted for us. So to protect the margins, a lot of FMCG companies have resorted to price hikes in order to go ahead and protect the kind of raw material inflationary pressures that they're facing. But moving on, let's now slip into a short break. HS Raghavendra Rao from DCX Systems joins us next to discuss their latest order wins from leading US defense player Lockheed Martin and more. Stay tuned. Welcome back. You're watching Midcap Radar. Well, like we promised, we are going to the management of DCX Systems. The stock is in focus as the company recently bagged over 800 crores worth orders from US defense player Lockheed Martin, and this for the supply of electronic assemblies. The company has a strong order book of over 3,000 crore rupees. To discuss this and more, we have HS Raghavendra Rao, the founder, Chairman and Managing Director of DCX Systems with us. Good afternoon, Mr. Rao. Thank you so much for joining us. First up, talk to us about this particular order win from Lockheed Martin. At the end of Q2, where was your order book with this particular order win? What is the order inflow for FY25 and where is the order book currently stand at?
Firstly, this Lockheed Martin order, we got totally about $100 million. This has to be executed in 12 months. Of course, this is related to the offset orders. And as on the order book, we have about 3,000 crore plus order book in hand. And going forward, we have a strong pipeline order to be converted to the purchase order. We are expecting to happen very shortly. There are final discussion with customer is happening, various customer as well as India and outside India. And looks very pretty good in the upcoming pipeline orders. We have a lot of good pipeline order has been lined and which has been almost is finalized, yet to get the purchase order from the OEMs. That's what.
So, Mr. Rao, you're talking about strong order pipeline that has come by. This recent order, is it higher margin than what you've been usually making? If we talk about EBITDA margins, the first half didn't look so strong versus the last year. You've seen a degrowth as well. What is the second half looking like in terms of order flows? And especially on this one, is the margin going to be higher?
See, firstly, as already I mentioned, our company, you cannot measure the quarter wise, like $100 order to be divided by $25 every quarter. This cannot be worked. Our major revenue or profitability come in the last quarter only, because there are constraints on the material supply and margin, NREs, and the BOM variation cost. It will be acquired in the end of the last quarter only. So hence, it will not be a compare for the last quarter, this quarter, and every quarter. And of course, the new upcoming order, we have a better margin. And because of the many things, as you know, we started our own backward integration for Renil. This giving more backup to improve our EBITDA. That's what I try to put it.
Okay, no, we understand that. What we want to understand from you is that, especially in the last couple of quarters, there's been quite a lot of variation, both in earnings, like you mentioned, lumpy business. But steady state EBITDA margin, if you look at it on an annualized basis, what is it that we can expect? And when you're talking about, the kind of order size that you've received from Lockheed Martin, at what EBITDA margins will you be executing this particular project?
Basically, until I supply and categorized everything, I am not able to disclose the EBITDA margin until we execute the POIs. This POI has been come very recently in the last 2-3 months. We are acquiring all the material. There is a class in the PO also, any upward and downfall for the material variation. Until we execute and ship, will not be able to disclose our EBITDA margin. But one thing, it is a better margin and better program what we have received it now. So I cannot give you the EBITDA margin exactly in the as on today, because all the material is in the pipeline to come and start production. There is a lot of testing, other process has to take place. Presently, I cannot able to define what is the EBITDA, but one thing, I'll assure you that we have a better margin in these programs.
Okay, all right. Mr. Rao, we get it. It's a lumpy business, can't compare it quarter to quarter, but year on year, we'll have to compare. That's how we assess whether the company is growing or not, right? Important for investors. First half, you've seen a decline of 30% in revenues, and profits have also declined. Can we say second half will be better than first half? What kind of growth rates are you looking for the full year, FY25, and maybe FY26 as well, if there's some visibility in terms of order pipeline?
See, you can see last 7 years from the DCX side, and the quarter-wise, you cannot compare. But there is a drastically increase in our revenue in the last quarter. And this also we are hoping to have achieve more than the last year revenue and EBITDA margin. That's what the company targeting. And there are possibility on the order book size and upcoming order. Now, mainly on the supply chain got improved. And there's the main constraint. This year, we are not facing, at this moment, we are not facing any challenges.
Mr. Rao, yeah. If you could just interrupt you. You said you're expecting a higher growth for FY25 compared to FY24. Could you give us a guided range, in terms of top line, in terms of EBITDA, in terms of margin and PAT? What is it that we can expect for H2 and also for FY26?
As you know, I have a lot of restriction in giving the guidance number, and that depends. I am not only executing with the one customer. Suppose I have a 4 or 5 PO. We have a different process, different margin. Which one I am going to ship based on the customer, that based on the numbers and based on the program and the process, my EBITDA is going to decide. So presently, I am not able to give guidance number until we have.
Mr. Rao, with the order book that you have in hand, could you give us a directional sense, if it's a mid-teens, if it's a double-digit growth, a single-digit growth, give us a sense of what is it that analysts can pencil in?
To be frank, I cannot able to disclose now on the what is until, see, it is not like when people knows when we get the PO, they know the margin. Because there is a variation in the raw material cost, which we are covered by the customer. So until we purchase and define the material cost, we will not be able to disclose. Of course, it is not going out of our pocket. It has to be claimed from the customer. That is a contract that is called a BOM guarantee we have. Today, I cannot able to tell you what is the EBITDA margin until I have a supply chain in control, material has come. I cannot define the margins.
Take that point, Mr. Rao. We tried, but of course, as you said, you will not be able to explain or give details on the margins as well. But after Q3, maybe some more details that will come up, and we'll get to know more about the outlook of the company as well. Thank you so much for joining us today with your insights. That's the word coming in from D6 Systems. But with that, let's dive into the Growth Code, an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed investment decisions. This week, week, CNBC-TV18's Nigel D'Souza sat down with Vishal Mehta, CMT and founder, Market Scanner, to understand why trading during low liquidity periods is risky. Let's listen in.
Why is trading, in a low liquidity market rather risky, especially in the F&O market?
Indian markets are the most liquid ones. Like Indian options market are considered to be the most traded contracts in the world. We have introduced next 45 stocks in the future segment. But liquidity is always when you are entering.
Yeah.
The problem is when you want to exit in a panic scenario, the liquidity dries up. So the more important part is you trade the liquid counters. And because I've seen in my personal experience, the stocks which were liquid, all of a sudden turn illiquid and you do not get proper exit. And in this scenario, the only thing that can save you in the derivatives market is a hedge position, because you know that this is the maximum loss that I'm going to incur.
Welcome back to Midcap Radar. Well, there's a bit of a bounce as far as the broader end of the markets are concerned. The oil and gas space today is doing quite well. Some auto stocks have recovered. Bajaj Auto now at today's highest point, significant up move after the kind of sell-off that it saw earlier today. And ICICI General Insurance or ICICI Lombard, that is the one that's doing quite well, up almost over 1%. So these are stocks that have seen a bit of a recovery after the sharp intraday sell-off. But moving on, AU Small Finance Bank is in focus on the back of a note from Citi. Abhishek joins us with more details.
Vivek, Citi has been holding a financial conference with respect to all the lenders under their coverage. And over there, AU Small Finance Bank had come in and mentioned some of the key points to investors. So first of all, Citi has a neutral rating, target price of 684 per share on AU Small Finance Bank. The key takeaway is that there is, given elevated stress in MFI, the bank has actually beefed up their collections. They have had 500 people to actually, go in for collections for early bucket resolutions. They expect the MFI credit cost to be elevated in H2 of FY25. Now, secured rural and secured semi-urban portfolio is doing well. However, given the fact that there might be continued muted economic activity, which actually may pose, downward risk to their asset quality. So they expect the loan growth to be in the range of 23 to 25% in FY25. Remember that the loan growth was about 25% in FY24, but that was before the merger of the South Indian entity that they had taken over. They have maintained their NIM at around 6% for FY25 with better visibility on cost of fund is what they have said. They are hopeful of getting the universal banking license in the next year, that is calendar year 2025. So for them, asset quality actually takes precedence over loan growth in the near term. Back to you.
Thank you so much, Abhishek. And you've been cautioning us as far as the entire lending space is concerned. One particular stock, if you could just highlight, that's the Bombay Stock Exchange, BSE. The last 15-20 minutes of trade, that particular stock has seen a very sharp upsurge. But with that, it's all the time we have on this edition of Midcap Radar Mutual Fund Corner. When we return.